probably the biggest two macro weeks of the year, in particular because we've got the elections coming up next week, but also next week is the second last Fed meeting of the year. And this week we are at peak earnings season. We have earnings, we have payrolls, and we have elections. There is a huge amount going on, lots to buffet the market around. And just looking back over the last 5 trading days, it's been a mixed picture, largely positive for broad markets, with some standout performers both to the up and to the downside. Google beating on earnings earlier in the week, opened up 8%, but has since drifted over the past few days. AMD went the other way, had a nice run-up trade into earnings, as we often see happening. And then once it reported disappointing chip sales, it dropped like a stone, and dragged down the likes of NVIDIA with it. NVIDIA reports a little bit late. It's still to come later in November. Overnight, we had Microsoft and Meta. On the face of it, not disappointing earnings. Meta slight beat, Microsoft beat, but on reflection, the market is disappointed by what it heard. A theme that seems to be building is the increasing or just the cost of AI research, and the fact that just the whole AI build across Microsoft, Google, and Meta. People ignored it for Google, but it was mentioned. Costs were mentioned there, and there was more of a focus overnight on Microsoft and Meta, who are both, I think, down about 4% pre-market. That's dragging NASDAQ futures down 1% pre-market, and we still have Apple and Amazon to come tonight. And of course, Amazon, a big cloud computing player, so no doubt that's going to be closely watched to see if that theme continues. So a little bit of a risk-off tone to the end of the week. That's hardly surprising given the event risk that we've got next week. Gold managing to keep on pushing higher, no doubt boosted in part by slightly better than expected data yesterday. We had the GDP reports yesterday, which continued to boost the dollar. Deep within that GDP report, this is slightly better than was better than expected consumption figures and slightly higher than expected inflation, and that just sort of is consistent with the trend of US exceptionalism, I suppose, with the US economy seems to be powering ahead, while the rest of the world struggles somewhat, and that is without a doubt driving the dollar higher. I've seen a chart somewhere else, I don't have it in the pack, but this has been the best 2-month period for the dollar in quite a long time. Yesterday, it was yesterday. We briefly touched on the fact that DXY is not a wonderful proxy for dollar strength, and that's because it is made up of 50% euro. The reason for that is the DXY index was put together back in the 70s. And back in the 70s, Europe was a major trading partner for the US, and the currency weighting was trade weighted. Post the Eurozone bringing in the euro, then all of the Deutschmarks and all these different currencies all collapsed into one, the euro, and therefore it became a dominant theme of the DXY. So these days, professionally, most people don't really look at DXY as a measure of dollar strength, because, as we saw, it is really dominated by euro. There's another index, which is not the most catchy ticker, the DTWEXBGX, but it's a Federal Reserve data series that is basically the trade weighted, dollar trade weighted, and that also encompasses emerging market currencies, and it's much more reflective of the US's current sort of trading partners. And so that index, you can find it on TradingView, and that is more representative of the broad dollar. And we can kind of see that in this chart where it's sort of coming in the middle of dollar yen, sterling, dollar euro, So that's the dollar index, and dollar continues to power ahead. Moving forward, commodities, silver and gold. We looked at this yesterday. Both continuing higher. I do think silver is vulnerable here to a pullback, potentially on margin increases, but both are moving higher. Interest rates also moving higher. One of the things driving gold higher is this increase in gold futures positioning, seen to be reflective of buying flow from the likes of emerging market central banks and governments and hedge funds and the like, but strongly correlated with gold. Those managed futures positions come off a little bit, but what we're not seeing on this chart is that over the same time period, ETF flows were falling, but they have reversed just unsurprisingly as gold has been pushing higher. FOMO, fear of missing out, has pulled in retail investors back into those ETFs. Again, just looking at the gold price over this period, pretty much flat. No surprise to see size dropped out of the ETFs, but that's coming back. So remember that for the majority of commodity ETFs like SLB and GLD, an inflow has to be matched with the concurrent purchase of the underlying physical. So inflows into these ETFs leads to them physically having to buy gold or exposure to gold through gold futures, which are physically deliverable. So it's kind of the same thing as owning gold. That's why we look at the gold futures. So that story continues, and no doubt will just keep on running into next year. And yeah, we'll pick on that up on that later in terms of ideas. Just a chart to show you where silver is in context, back to on a monthly basis anyway, back to where we were in the 80s. So silver is extended. Last time we got up here, one of the reasons it smashed down quickly were margin increases. So that's, I'm slightly concerned about silver. I'd expect this chart to continue with 20-year rates moving higher, TLT moving lower. That might be an opportunity, both in advance of the election and potentially after the election if we get a red sweep. The next chart is, yeah, this is just the macro data that we've got coming up this week. You can see that the GDP number actually missed slightly yesterday. But as is often the case with economic data, there's a whole bunch of detail. There's much more detail within this than just one number. There's a whole sort of internal, what we call the internals of the number, and the internals were strong. They showed increase in consumption, and they showed inflation going up. So, despite the fact that looked like it missed, it was still seen as a strong number. And led to more interest rate cuts being priced out. Today we've got, just before the market opens, we've got inflation coming through, so that will be closely watched. The inflation component of GDP was higher than expected, so maybe that gives us a nod to what might happen today. Equally, it's not on here, but we had ADP payrolls, so ADP comes out before non-farm. We'll look at that a little bit later, but that came out higher than expected, and indeed, for the last wee while, ADP has actually underestimated payrolls. So if anything, payrolls could be, who knows, don't want to put a number on it, but certainly trading economics are going for a big number versus the consensus. I wouldn't be surprised to see something in that region. If not larger, and unemployment continues to be at really quite aggressive levels historically. We got another chart to look at that later. We got some ISM numbers as well. They're unlikely to move the needle ahead of the election next Tuesday. And not to forget that post the election, we've got the Fed and the press conference, and we've got for those in the UK, we've got the Bank of England. We'll see if they have anything to say about the moving gilts yesterday on the back of the UK budget. We won't go into that. This is the ADP that I was talking about, these ADP figures. Big number yesterday, bigger than the month before and bigger than expected, the largest number that since June. And that over the last while, this is the difference between the ADP number and the payrolls number. And we can just see that over actually the last 3 months, ADP has underestimated payrolls. So that's, maybe a nod towards the fact that we might get another surprisingly high payrolls number tomorrow, which would just, I think, continue to boost the trend that we've been seeing of stronger dollar, higher interest rates. This chart is something that we call a surprise index. You may or may not have heard of these. They sometimes get mentioned in the press, and it's basically most of the big banks have them. And it tracks, this one is for the US labor market. So it's just tracking all of the data releases, and it's looking at whether or not the data release came in above expectations or below expectations. It's a mean reverting series, so you can see that the level doesn't matter all that much. It's somewhat more the trend, and you can see very clearly from June into the end of August, we were hit by a bunch of negative surprises, and that dragged down the equity market. If you remember, in July into August, that's turned around. Partly that was payrolls back in October, but we've had some more recently. So just in general, the trend for labor market data seems to be surprising to the upside, and I think that's just consistent with what we've been seeing, and that's likely what's driving the strength in the dollar and interest rates higher. It's not really the probability of Trump getting into power that's driving it. I think it's more the underlying economy. Just a quick zoom out. People talking about and getting somewhat worried about unemployment moving down. Not anymore, I suppose, but we were back in July. But just to put it into context, this is a long run chart. The red line is unemployment going back 20 years. Current level of unemployment, I mean, it doesn't look concerning, does it? Right? I mean, around 4%. That's some respects low. So I don't think there's any real concerns over unemployment. The next chart is an interesting one. If we divide job openings by unemployment, we can get a series that sort of tells you how many jobs are being advertised or are available for each one job seeker. Now that, as we all know, that doesn't mean that it's necessarily easy to find a job, but it's a measure of labor market tightness, and we see that going into COVID, it was about 1.2 jobs for every job seeker. That obviously collapsed during COVID, but then very rapidly accelerated as we came out of COVID and the pandemic, and businesses struggled to hire, and it went as high as 2 jobs for every person. And where we are is sort of back to just below where we were pre-COVID, but still a very tight labor market by historical standards, and labor market tightness is associated with inflation and associated with wages going up. So the labor market is still relatively tight. Another reason why the Fed and others are not overly concerned about the US economy. And that's led to this sort of thing happening a month ago. The distribution, this is looking at a year of where we expect US interest rates to be. So a month ago, the center of the distribution was around 3%, about 2% lower. Since that data has improved, we've shifted expectations about a percent higher. So rather than expecting a 2% cut in rates over the next year, the market has shifted to expecting a 1% cut in rates, which typically would not be positive for equity markets. But I guess the context is that the economy is doing better than expected, and therefore, for the time being, that's seen as better for businesses, perhaps or better for the equity market to be going up on the basis of economic growth earnings than liquidity handouts from the Fed, shall we say. So that's all indicative of a positive market backdrop. Earnings, as I'm sure all be aware, really this is the biggest week of earnings for Q4. It's about 54% of companies reporting. We've already seen Ford disappoint, AMD disappoint, Google beat, Tesla last week beat, Microsoft and Meta, even though the earnings were not terrible, still have disappointed the markets. Eli Lilly also disappointed. Not that they're not selling enough Mounjaro or the weight loss drugs. It's just that they've had supply chain problems. So the demand is still huge for that stuff, but they haven't really been able to ship out enough, not hit their numbers. Said Microsoft and Meta just some concerns over how much they're spending on cloud and AI, and that's why tonight there's going to be a strong focus on Amazon and Apple into the end of the week. But I think probably not all that surprising that with all of the event risk we've got tomorrow and early next week, that people are choosing to be cautious and take down risk, and maybe using slightly lackluster earnings as an excuse to sell. So the reaction, I suppose, to Microsoft and Meta is perhaps a little bit overdone, just because it's coming at a time where I think if you're a portfolio manager, if you're taking risk, it's much easier to reduce risk into next week than increase it or keep it constant. Always, as they say, you don't get fired by buying IBM. I don't know what the modern equivalent of that is. You don't get fired for buying Nvidia, maybe. You don't get fired for doing what everybody else is doing. That is the way. That's just what I was talking about. Big week for earnings, and also just makes the point that once we get through this week and we're into November, we've chalked off about 70% of the companies. That's important for another reason, because while companies have upcoming earnings, they're in blackout periods and they can't buy their own shares. So the buybacks stop over this period, and they're just about, as we'll see on the next chart, they're just about to restart. So this is a rolling estimate of buybacks, and you see it has this sort of sawtooth, as we would call it in engineering or physics. It's a sawtooth pattern. It's up and down, and that's because these are the earnings periods where they're in blackout, and you can see that we're right in the middle of it, and we're about to go back into a period where companies are free to buy back their shares, and the expectation is it's going to be continue at pace and indeed even accelerate, and big numbers, right? 50 billion, a number of 50 billion. So that's definitely a tailwind for the market. Another interesting little sort of factoid, even though we're coming into what is a historically, seasonally, a very positive time for the market for reasons that we'll look at. The open interest in QQQ calls is very low. So this chart is just showing you, might be a little bit difficult to understand at the start, but these are just all the major option expiries. So they're the main monthly expiries going back a year. And what the chart is doing is it's looking at 20 days up to 24 days, T minus 24 before expiry. What was the open interest for each one of these maturities? And no surprise, December, the quarterlies are always have the bigger open interest, but it's just pointing out that over the whole previous 12 months of major quarterly expiries, the open interest for November is on the low side. Well, it's at the absolute low. So again, I think that's consistent with what we've talked about. You can see it's in the 0th percentiles over 1 year, and it's in the 36th percentile for the last 5 years. So again, just consistent with what we've been talking about. The upside in markets is not over-owned. If anything, institutions and big players are very well protected, and that's another reason why post elections we may see a rip into the end of the year. This is another reason. This seasonality chart, I'm sure you've all seen versions of this. We're not there anymore. We're kind of over here now. Indeed, we're just about here. So we're just about to go. So failing, I think the most negative outcome next week for markets would be a contested election, no real clear winner, and a lot of noise, a lot of legal challenge, and possibly even some social unrest, coupled with a Fed that comes out on the 7th, cuts rates by 25 basis points, but is less dovish than the market expected. That could see, more likely that would see a dip down, but there is still a very strong seasonality, so that may not preclude a year-end rally, but a lot of event risk next week. But the backdrop is very positive from now through to the end of the year, at least in terms of seasonals. One of the reasons for that, there's lots of different reasons, but one of the reasons is that mutual funds, big US mutual funds, have their year end at the end of October. Don't ask me why, but they do. Franklin Templeton, the fund company I used to work for, that was basically a mutual fund company. They have their official sort of calendar year ends at the end of October. They pay their bonuses in November. In the UK, calendar year end for business is typically March, but for a lot of the US, it's the end of October. And these guys are typically selling stocks in October and seeing big inflows in November. So they turn from the big mutual funds, turn from sellers of stocks, or at least not big buyers, to big buyers in November, and that's another reason that is often cited for this positive seasonality in November, because these guys are buying at the same time as we saw corporates are buying back the stocks, and there's another player a bit newer to the game, what we call vol control funds. So these are big funds. You can see the numbers over here are in the hundreds of billions in terms of their equity exposure. Their blue line here, their allocation to equities. And what the chart is trying to show you is that when equities are volatile, like here, these guys sell. They cut their equity exposure as volatility goes up. So as VIX goes up, they reduce size. As VIX goes down, they buy more. So they're kind of, the idea behind that is that, you know, equity markets sort of do these kind of things, don't they? They go slowly, and then they get more volatile, and then they get sort of like that, and they obviously have a trend. It probably looks a bit more like this, you know, trend up with volatility. What they offer, what they promise their clients or seek to achieve is a sort of smoother experience through that. So that the big cut out the big peaks and troughs, and that's why they call it vol control, because the idea is that they're controlling the volatility. And one of the ways they do that is to use actual realized volatility, to some extent implied too. When realized volatility goes up, they sell. When it goes down, they buy. And they're quite formulaic, and because of that, a lot of the investment banks have sort of cottoned onto it. Nomura were one of the first, with Charlie McElliott. Nomura was one of the first. And they produce these kind of things that just give you a bit of an estimate to say, well, if S&P volatility, realized volatility, stays around sort of 0.5%, whereas it is at the moment, it's quite low, then over the next month, these guys might have 65 billion to buy. If it stays there for 2 months, they'll have to buy more, and so on and so forth. Obviously, if S&P volatility were to go up, they turn net sellers. So they can push the market in either direction. Somewhat ironic, given that what they seek to achieve is lower volatility, but by their very actions they increase it. That's just one of the paradoxes of investing. But yeah, that's just another potential tailwind for markets could be vol control funds getting re-engaged and buying. Can't ignore the election. Polymarket odds. Actually, since I took this screenshot, they've actually dropped a little bit. So they actually moved a tiny bit lower. I don't know if that's because of the Puerto Rico comment or not, but they have dropped a little bit. But still, the prediction markets are very much going for Trump to win. You can see that they've got him ahead in all of the swing states, which of course is important given the electoral college approach the US takes. Harris still looking from a prediction market point of view, odds on to take the popular vote, but they have Trump taking the presidency. They also have the Republicans, odds on, shall we say, but certainly versus where the Democrats are, much more likely a red sweep, a Republican sweep, so the Republicans taking Congress. And Trump winning seems much more likely than Harris winning in a Democrat sweep. So Democrat sweep, even considering that the skew in the prediction market seems vastly unlikely. So it looks like the potential outcome next week is either there are three potential outcomes. You have a Trump presidency, so Republican presidency, Republican Senate, Democrat House. That's seen as 16%. Democrat presidency and then a Republican Senate, Democrat House is 21%. So you have this sort of gridlock. This is the sort of gridlock outcome where you've got a Democrat president and Congress split. This outcome is marginally equity positive, depending on what people think about how tariffs will impact growth. But they still won't really be able to get any big policies pushed through because they don't control Congress. The Republican sweep takes us back to a 2016 scenario where big tax cuts could be on the table alongside a bunch of other stuff. So that's the most positive market outcome. There's no, this is not a big negative market outcome. I think, as I said, that what's the negative scenario for markets is more perhaps this outcome and a very, very heavily contested, very, very too close to call. So neither, or indeed, this outcome, which is too close to call as well, because we've heard that the Democrats are quite equally as litigious as the Republicans this time around. So a too close to call contested result sort of leaves neither incumbent with a very strong mandate to govern or indeed the ability to get their policies through. But I think we will find out next week. Just a point to which we've talked before about the fact prediction markets are not probability. There are lots of polls around, but I think two of the best are probably The Economist. They've got quite a complicated prediction model. You can go to The Economist and read about it if you like, but you can see that's a dead heat according to The Economist, exactly 50-50. From The Economist point of view, there's another polling group that are quite well regarded, Real Clear Politics, and they, interesting actually to see these guys, and they really do try to get state level polling and adjust, and they are seen as one of the more accurate. But it is interesting to see that the trend, at least the trend here, matches the prediction markets, with Trump just pulling ahead and the Democrats dropping. The actual scale of the difference is minute. It's 0.4%, but the trend is similar. So maybe there is something in that trend in the prediction markets that we've seen. But all of that can change even on election night, as we know. Someone asked about, yeah, expected moves. The expected move for this election, if we just look over the past year, right now is as low as it has been all year. So despite the fact that VIX is slightly elevated, it's not as elevated. The markets are not predicting as big a move as they maybe were back at the start of the year. That's slightly unusual. Maybe that not points towards the prospect of it just being too tight to call and not actually having. Remember, this is a one-day move, so not actually having any result on the 6th of November. Quite likely, I think. Bond markets are actually the opposite. Bond markets, the equivalent for the bond markets of the VIX is the move index. So the move index, if you do the math, and the guy that did the math on this was the guy that created the move index, I think we can believe him. The actual the premium, if you like, that's in the move index for the election is the highest ever, 24%. We can ignore 2020 because that's COVID, and to some extent 2008, people had other things on their minds. If you cast your mind back to the 4th of November 2008, it was, yeah, I can't remember exactly the analogy that he used, but it's something like asking a drowning man whether he wants tea or coffee. They're not really bothered. But yeah, certainly going back over history, back over to the 80s, the bond market is particularly concerned with the elections this time round, and that is perhaps because treasuries have been moving higher into it, because we've got very strong macro data, and the expectation is whatever incumbent that comes in will certainly not act to reduce the deficit. So just interesting there to see the disconnect between the bond market and the equity market. Bond market certainly a lot more concerned. Just another chart shows you the same sort of thing. This is the move index versus the realized volatility. So a big gap between what bonds are actually doing day on day and what the move index is predicting they might do over the next month or so. And again, you see that there. So that's just indicative of a lot of hedging in bond space and some discomfort. One of the things we picked up on recently was Goldman's, sort of shifting gears a little bit and zooming out, but Goldman's put out a report about this sort of secular stagnation. I remember the word now, I forgot it the last time. It's been so long since anyone's spoken about secular stagnation, this idea that because of QE, we pulled forward years of equity returns and therefore, our best days are behind us kind of thing. They put out a report saying they expect the annualized return for equity for S&P to be about 3% going forward. This guy, Ed Yardeni, and you can look him up, very bullish. He's a perma bull, shall we say? So no surprise he looked to push back on it. But I thought this was a pretty cool chart. It just shows that if you go back to 1935 and you compound and you look at what was the annualized return since 1935 for the S&P, it sort of sits within this level of 6 to 7% in price terms, 6 to 7%. If you include dividends, if you reinvest dividends, it comes out more consistently around 10, 11. So with dividends reinvested, it seems really hard to get down to 3. So I think, just pushing back a bit on, and this is a log scale, as you can see, just pushing back, and these are recessions, the little gray bars. So recessions do dent things, but it comes back again. So you see recession took it down from 7 to 6, but we're back up to 7 back in early 2000s with .com, turn of the century euphoria. We got a little bit higher, but this sort of 6 to 7% is consistent, and it's consistent with what I've always thought of equity risk premium, which is around 5 to 6 to 7%. I think one of the reasons Goldman's were pushing for a much lower number, one of the reasons they cite is valuations, but there's difficulties with that too. Far be it from me to suggest that Goldman's might be suggesting people don't just buy passive equities and maybe do something else. I mean, why would they do that? I don't know.